Welcome, everyone. Today, we're diving deep into the fascinating world of manufacturing cost accounting. If you've ever looked at a massive, humming factory and wondered exactly how every single bolt, screw, and hour of labor gets transformed into a product cost on the balance sheet, well, you're in exactly the right place. We're going to build this entire system together from the ground up.
To ground our session today, we're going to follow the rigorous curriculum of the University of Economics and Law, specifically the Faculty of Accounting. Our main goal here? To bridge that gap between dense academic theory and real-world business practice. By the time we're done, you won't just be memorizing journal entries. You'll understand the strategic, systems-level thinking behind the entire production cycle.
All right, let's take a quick look at our roadmap. We'll start with the TNFAT materials example, move on to some common labor cost pitfalls, and then compare depreciation methods. After that, we'll tackle the Southern Furniture case study, break down the core costing formula, and finally, wrap up with some strategic business solutions. Let's get right into it.
Section 1. TNFAT materials. This is absolutely our first building block.
Think about it. Raw materials are the very foundation of production. Before a factory can build a single thing, it needs materials. But in accounting, receiving inventory isn't just about recording the sticker price. We have to strictly follow the historical cost principle. Consider the journal entries for TNFAT Mechanics when they bought 5,000 kilograms of steel rolls. Obviously, the 90 million VND purchase price is debited straight to account 152, raw materials. But pay close attention to that second entry, the 2.2 million VND freight cost. That doesn't just get dumped into normal operating expenses. Nope, it's directly capitalized into account 152 as well. By accounting standards, your historical cost has to include the purchase price, plus every single cost incurred to get those materials into the warehouse, like loading, unloading, and shipping. It's the whole shebang.
Moving right along to Section 2, labor costs. And we're going to focus heavily on avoiding some really common pitfalls here.
So, we've got our materials, and now we need people to actually do the work. Listen up, because this is a massive trap that students and, honestly, even rookie accountants fall into all the time. The payroll accounting process has 5 basic steps. Calculate salaries, calculate employer contributions, calculate employee deductions, remit the insurance, and finally pay out the net wages. The absolutely crucial parts are steps 2 and 3. You cannot mix these up. That 23.5% employer contribution, which covers social, health, and unemployment insurance, plus union fees, that's a company expense. It gets added directly to the overall production cost. But that 10.5% in step 3, that is a deduction taken straight out of the employee's gross wage. It does not increase the company's production cost, it just shrinks the worker's take-home pay. Make sure you draw a hard line between these two when you're doing your journal entries.
All right, Section 3, manufacturing overhead and depreciation.
Manufacturing overhead is basically a giant bucket where we collect all our indirect costs. We're talking factory management salaries, utilities, and of course, the cost of heavy machinery. Once we've gathered all that, we have to allocate it to specific products, usually based on direct labor hours or machine hours. Now, a huge chunk of this overhead comes from machine depreciation. Let's compare the two main methods. First, we have the straight line method. You take the original cost, divide it by its useful life, and boom, you get a steady, fixed expense every single year. It's super easy and very common. On the flip side, we have the units of production method, which is directly tied to your actual output. If a stamping machine produces 1,000 parts this month, you expense 1,000 units. If the machine just sits there turned off, 0 depreciation. For a production line that fluctuates a lot, this output-based method gives you a way more accurate picture of product costs than just spreading it evenly over time.
That brings us perfectly to Section 4, our capstone case study featuring Southern Furniture.
Okay, we've got our 3 core building blocks: materials, labor, and overhead. Now it's time to actually apply this theory to a real-world scenario. Southern Furniture is producing a batch of office desks this May. But before we crunch any numbers, let's lock in the master formula. Total product cost, which we call Z, equals your beginning work in process plus total costs incurred during the period minus ending work in process minus any recovered scrap. And the absolute center of gravity here is account 154. Every single direct material, direct labor, and manufacturing overhead cost gets funneled right into account 154 to build out this formula.
Let's trace exactly how Southern Furniture's costs flow into account 154 for the 800 desks they finished. First up, direct materials. They issued 450 MDF boards, which we gather in account 621. Next, direct labor. We have $120 million in direct worker wages, plus that 23.5% employer contribution we hammered home earlier, giving us an extra $28.2 million. All of that goes through account 622. Finally, manufacturing overhead, stuff like CNC machine depreciation and factory management salaries, goes into account 627. We take all these costs, transfer the whole lot into account 154, apply our formula, and we can nail down the exact manufacturing cost for those 800 desks.
Let's look at the big picture now, in Section 5, Business Results and the Strategic Debrief.
Producing the batch is really only half the battle. Southern Furniture finished 800 desks and just sold 600 of them to a partner. Now we have to analyze the business results to see if they actually made any money. When we analyze the data, we spot a classic problem. Gross profit looks solid at 71.5 million VND from selling those 600 desks. The production team did a great job optimizing costs, but total operating expenses, which includes selling and admin costs, shot up to over 73 million. That entirely wiped out the gross profit. And to make matters worse, the company took a hit of 7 million from a loss on disposing of an old lathe this month.
Which leads us to this glaring red flag, a net loss of 8,605,000 VND for the period. This is an incredible lesson in management, guys. You can calculate production costs perfectly, you can sell products at a great gross margin, but if your operating expenses are out of control and your timing on asset disposals is poor, you're still going to lose money.
So, I'm throwing this question to you. If you were the chief accountant sitting in a boardroom right now, staring at that net loss, what measures would you recommend to turn things around next month? We can't just record a loss and shrug our shoulders. We need to offer real strategic financial solutions.
Let's break down some actionable solutions. First off, the company has got to strictly control its selling and administrative costs. They're way too high and completely out of sync with the gross margin. We need to review and tighten those operating budgets immediately. Second, and this is just as critical, we need to rethink the timing of fixed asset disposals. Eating a 7 million loss on an old machine during a month when operating costs were already overwhelming? That's a huge strategic error. If we had just delayed that disposal to a more profitable quarter, we could have protected this month's bottom line.
To wrap up today's session, I want to ground everything back in a fundamental rule of accounting, the matching principle. Cost of goods sold must be recorded in the exact same period as the related revenue. When we sold those 600 desks, we recognized a precise proportion of materials, labor, and machine depreciation in our COGS that matched the revenue those 600 desks generated. That, my friends, is the rigorous, systematic beauty of cost accounting.
We've covered a ton of ground today, from properly recognizing TeamPot's raw material costs and dodging those payroll traps to allocating overhead and diagnosing Southern Furnace's bottom line. So here's my final question for you. Now that you see how tightly a factory's floor is linked to its financial statements, are you ready to use this systems thinking to uncover the real story behind your next internship or financial audit? Thank you all for joining today's masterclass, and keep up the great work.